So I get a screaming headache every time I see the numbers on the automobile market in the United States. It's absolutely insane. The cost of a vehicle these days is just completely outrageous. And how does this happen? I think it's largely due to the use of debt. U.S. consumers have continued to take on more and more debt, extending the life of loans beyond anything that's reasonable. And that's what we're going to cover in today's video. New to the channel, this is A Simple Dollar. My name is Dustin. We make content related to personal finance, investing, and basically everything to do with your money. So make sure you drop down and hit that subscribe button. You can also check us out over at thesimpledollar.com. We have a lot more content over there as well. If you enjoyed this video at all, we'd really appreciate it if you drop down and hit the like button, and we'll leave links down in the description to basically everything that we've talked about in this video, so make sure you hit that as well. According to a recent report by Experian, the average monthly auto loan payment was a whopping $569 in the first quarter of 2020. When I think about car loans, I just mentally default to a 5-year loan. I thought that was kind of standard. But what we've seen is the extension of auto loans out to as much as 7+ years. You're talking about 84 months that you're paying off a car. And if you've ever been to a car dealership, you'll know that one of the first things they usually talk about is monthly payment. They don't talk about the cost of the car, they talk about the monthly payment. The reason why they talk about monthly payment is there's really 3 factors that go into how much you're gonna pay for the car. First is the total cost of the car. Second is the interest rate that you're gonna finance the car at. And third is how long you're gonna be financing the car for. Now, if they just focus on the monthly payment, they kind of take the attention away from all the other variables that really impact the total cost of the vehicle. And if you want access to our car buying guide, make sure you check the link in the description below. But at a 7-year loan, you're talking about paying off a car over the course of 84 months. So let's talk about 5 reasons why nobody should be taking out a car loan for 84 months. So reason number 1 is you end up paying a lot more over time. So what a lot of car dealerships will advertise is getting your monthly payment lower. So let's say you took out a $29,000 loan at a 4.6% interest rate. If that's over the course of 67 months, your monthly payment is going to be $492. In total, you would pay about $4,000 worth of interest. If they stretch that same loan out to 84 months, now your monthly payment drops to $404, but you end up paying about $1,000 more in interest over the term of the loan. So you get the same car, your monthly payment is lower, but you end up paying $1,000 more. Reason number 2 is you will definitely be upside down on the car. Upside down means that you owe more on the car than the car is worth. So say you get in an accident and the car is totaled. You're gonna have to pay more to pay off the loan as opposed to what you would get for the car's value. Same thing if you went to go sell the car. You're not gonna be able to sell it for enough to pay off your loan. That could really put you in a financial bind because not only do you have to pay off the original loan, you've got to come up with money to pay for another car. Reason number 3 is you're gonna have a tough time finding a manufacturer's warranty that extends out to 84 months. Why does that matter? Because you think about it, you're gonna be 6 to 7 years into the life of the car, and you start having major issues with the car at that time. So now you're still making your monthly payments and you have to come up with the cash to get the car repaired. That can really put a financial strain on your budget. Reason number 4 is if you're having to stretch a loan out to 84 months, chances are you're probably buying more car than you can really afford. It's probably gonna feel like you're okay because the monthly amount that you're paying for the car is gonna fit within your budget. But when you're stretching it out over that period of time, it's really gonna make you poorer over time. Instead of stretching it out that far, really the best option is, if you can possibly do it, pay for a car in cash. And I know that's kind of like eating an apple without chewing, but if you can pay for cash, you can definitely find a car that's gonna be within your budget. And if you wanna see the math on how paying cash versus financing really works out, we'll leave a link in the description to an article that details that whole process. And if cash is just really not an option for you, at least find a loan that's gonna be 5 years or less. That's gonna make sure that it's a car that you can actually afford. Reason number 5 is that a car is a depreciating asset. So when I think about things that really destroy wealth for individuals, one of the first things that comes to mind is gonna be a car. So not only are you buying an expensive item that's quickly losing value, so you're talking about losing 10% the moment you drive off the lot. Just a handful of years in, you've lost as much as 50% of the car's value. All while you're paying interest on the loan to pay off the car. So you're paying more than the car is worth because you're paying interest, and you're rapidly losing value in the asset that you purchased. What the auto industry knows is that the longer they stretch out the life of these loans, Not only the more car that you're able to afford, but also the more interest they're able to receive. This is a game that the auto industry plays, and make sure you don't fall into this trap. In many cases, being average is good enough. If you get an average GPA in school, you still get a degree. But when it comes to auto loans, being average in the US is really not that great of a deal at all. Don't end up spending $400, $500, $600 a month for 6 to 7 years. It's really going to inhibit your ability to build wealth over the long term. So that's going to be it for today's video. If you enjoyed it, we'd really appreciate it if you hit the like button, subscribe if you haven't already, and for the simple dollar, my name is Dustin. Look forward to seeing you again soon.